Moving on, acquisition costs. So if you went over the lesson notes, so there's two things you can do. You can either go through the lesson notes or you can watch the video, um, or maybe a combination of the two. If you did that, as I reminded, you will remember that acquisition cost includes not just the cash paid, but can also include fair value of common shares transferred. If there could be other non-cash consideration in the form of assets being transferred as well to complete the business combination. Sometimes there might be a promise to pay an additional amount that depends on some future event, some future outcome, which is not certain. If that were the case, then that is a contingent consideration. And for contingent consideration, the um, the standards require us to estimate the amount that is expected to be paid out using a system of probability weighted, um, like expected value using weighted probabilities, and include that amount expected to be paid in the transaction cost, in the cost, the acquisition cost. So in here, we have Alpha Company on Jan 1st, 2001. Alpha Company acquired the outstanding shares of Lambda Corp for $1.2 million, with the purchase consideration being paid partly in cash, 500,000, and partly by issuing common shares to the shareholders of Lambda Corp. Of course, you don't need to be a huge math whiz here to figure out that the fair value of the common shares issued is 1.2 mil minus 500,000. Yeah, 700,000. Professional and legal fees related to the acquisition amounted to 50,000 paid in cash. Remember, professional and legal fees are not to be added to the cost of acquisition. Instead, they are expensed. Stock issuance costs of $40,000 were paid. Again, these are not part of the cost of acquisition. These stock issuance costs are capitalized to the common shares. Separately, though, Alpha Company also promised to pay an additional $300,000 to the former owners of Lambda Corp if net sales increase by 25% over the next 2 years. So that is the contingency here. We will pay an extra, or Alpha needs to pay an additional $300,000 if sales were to go up by 25%. If they do not, then nothing additional needs to be paid. The standards require management to estimate the expected payout. So Alpha Company estimates the probability that Lambda sales will increase by this 25%, which would kick in the additional payment over the next 2 years as being 40%. There's a 40% chance that sales will go up by 25%. I mean, 60% likelihood of sales not going up by 25%. Alpha's incremental borrowing rate is 8%. Okay, that 8% would be useful as a discount rate. So first part, you're asked to calculate the acquisition cost and prepare the journal entry to record the acquisition. So acquisition costs. Calculation of acquisition cost. This would include the cash paid. So we paid $500,000 in cash. We issued common shares. Now, the total consideration was 1.2 million. Out of the 1.2 million, if we paid $500,000 in cash, The difference, 700,000, was in the form of common shares. Now, these two clearly make up the 1.2 million that we saw up here in the first line, but they're not all of the acquisition cost. There is in addition to these two, there is the present value of contingent consideration. Need to calculate that, right? We need to calculate the present value of the contingent consideration. So for the contingent consideration, if sales increase by 25% or more, the additional amount to be paid is $300,000. Alpha Company also promised to pay an extra $300,000 if net sales increase by 25% or more. If sales do not increase by that amount, so if sales increase by less than 25%, the amount payable is zero. Now, according to management, probability of that occurring, probability that sales will go up by 25%, according to Alpha Company's management, is 40%. There's a 40% chance that net sales will go up by 25% or higher. Okay? Which means there's a 60% chance of that not happening. If you calculate the expected amount then, right, the expected value, the probability multiplied by the amount to be paid. There's a 40% chance that Alpha will need to pay $300,000. There's a 60% chance that Alpha will pay nothing. So the expected value, the probability weighted amount of the contingent consideration is $120,000. So when will this happen? This will happen in 2 years' time. Alpha expects to pay $120,000 in 2 years. What is its present value? Well, for that, you need to do a little bit of math and say, okay, if I have a future value of 120,000 and that is expected after 2 years with no payment in between, at a discount rate of 8%. Alpha's incremental borrowing rate is 8%. So that's a risk-adjusted discount rate. Calculate PV. So if you calculate PV, present value, you have to input the rate, interest rate, the number of periods, the payment each period, and the future value. And that works out to 102,881. So discounted value of the contingent consideration is 102,881. That amount is added to the acquisition cost. So total acquisition cost is $1,302,881. Okay, is that understood? Okay. Now, they also ask for a journal entry to record the acquisition. So this happens on Jan 1st, 2001. You will debit investment in Lambda, $1,302,000. Credit cash, $500,000. Credit common shares, $700,000. And then the present value of the contingent consideration, you credit contingent consideration liability. Okay, so we paid cash of $500,000. We issued common shares with a fair value of $700,000. And the present value of the expected payout in 2 years' time, because it is contingent on sales going up by 25% or more, we set up as a contingent consideration liability. So it is something that we will actually be paying, hence a liability. All right. Now, they also incurred professional and legal fees, $50,000, stock issuance costs, $40,000. These were paid for in cash. So for professional and legal fees, make sure you tell me very clearly that that's to be expensed. For the stock issuance costs, make sure you debit common shares. So $50,000 for the professional and legal fees expense, $40,000 for the stock issuance costs. These were paid for in cash, credit cash for the $90,000. Okay. Part B, prepare the journal entries that will be recorded by Alpha Company to accrete the contingent consideration for years 2001 and 2002. So what happens is we've recorded the contingent consideration liability at $102,881. That's the present value. The actual expected payout is $120,000. So the difference between these two amounts is the interest expense that needs to be accreted over the years. So for that, it's not a bad idea to make an amortization schedule. So on Jan 1st, 2001, the contingent consideration liability was 102,881. Each year, at the end of the year, interest will need to be calculated at 8%. Now notice there's no payment. We're not actually paying out any cash until the second year is over. And even then, it depends on sales going up by 25% or not. So there's not going to be any cash payment. Interest is to be calculated at 8%. So 8% of 102. The first year, interest works out to $8,230. When you're looking at the amortization, Nothing was paid, but we record interest expense. So we're going to see a negative amortization as far as the liability is concerned. Now, if you remember, amortization reduces the balance. Negative amortization basically will increase the balance. So the balance in the liability will go up to 111,111. For the next year, the interest will be 8% of this 111. That's the negative amortization, and putting the negative amortization into the balance, we see the liability go up to $120,000. That's a pretty straightforward. You may remember it from asset retirement obligations from intermediate two. That's pretty much what happened there. You kept accreting the retirement obligation. Now, under IFRS, the accretion, the term for accretion is interest. I know under ASPE they use accretion expense. IFRS we use interest. So on December 31st, 2001, the journal entry is going to be debit interest expense. $8,230, and credit the contingent consideration liability by that amount. December 31st, 2002, debit the interest expense and credit contingent consideration liability, $8,889, credit $8,889. That was part B. Okay, any questions so far? Okay, if you say so. Part C. It's got two subparts, two situations. First one, sales increased by 30%. Part two, sales increased by 20%. Now, why do they matter? 30% is when sales went up by more than 25%, there will be $300,000 to pay. If sales went up by only 20%, then there'll be nothing to pay as far as the contingent consideration is concerned. So part C1, sales increased by 30%, additional payout of $300,000. This happens when? December 31st, 2002. Think about it. We'll be paying $300,000, so that's the easy part. Credit cash $300,000. We will no longer need to have this contingent consideration liability, so you can debit the contingent consideration liability. The amount is $120,000, right? The balance in the contingent consideration liability has been increased up to $120,000 over the 2 years. There is a difference of $180,000. See if you can figure this out. Hopefully I primed your memories there. I've talked about the asset retirement obligation. It's kind of analogous to that situation. You had expected to pay out $120,000. You actually ended up paying $300,000. What would you do with the difference? Okay, I've got two suggestions here. From Rika, there's a suggestion about debiting goodwill. From Darcy, debit the investment in Lambda. So let me just remind you again, asset retirement obligation, we're talking about retiring a liability, right? You're retiring a liability by paying more for the liability than you had on your books. Now, it's a nice little multiple choice question, right? It's a natural experiment. So I've got option A is goodwill, option B is investment in Lambda, option C is loss, and option D is accretion expense. So four options, they all seem pretty good. I do want you guys to think about it, because like when do we actually develop professional judgment, that kind of stuff. In order to develop judgment, you need to first be very comfortable with your basics. So what is happening here again? You're retiring a liability. Okay. You are retiring a liability and you've paid more for the liability than you expected to. So over the years, conceptual framework, etc., what makes the most sense in this case? You had a liability and you actually ended up paying more for the liability to settle it. You had to settle the liability and you ended up paying higher. Okay, I'm seeing support for the loss. What do the others think? Okay, that's three strikes for the loss. Loss it is, okay? Loss on retirement of contingent consideration. These are basic things, folks. When I mean, if you're squaring off a liability, if you ended up paying less for the liability, it's a gain. If you pay more to settle the liability, it's a loss. Goodwill only arises at the time of a business combination. Okay, so goodwill would be in play here if, and we don't have the information to go in and figure that out, if the sum of the net book value and the fair value differences of Lambda was less than the 1,302,881, then the difference will be goodwill. Okay, so goodwill can't happen after the fact. The investment in Lambda has been correctly recorded at the acquisition cost. The definition of acquisition cost is any cash paid, fair value of any equity or other assets transferred, plus the present value of any contingent consideration. So that has already been dealt with. So no, we're not going to debit the investment account again. The accretion, which in the world of IFRS is called interest expense, has already been played out with the increase of the contingent consideration from its present value to the expected amount at the end. Okay, so those were not trivial options that you did come up with. It's not as if you were totally out to lunch, but you need to be able to think your way through, reason your way through why it's not goodwill. It's not goodwill because we don't have, so goodwill is only calculate. So how do we know if there's goodwill? We know if there's goodwill if we find that the fair value of the net assets taken over is less than the consideration transferred. The contingent consideration transferred is 1,302,881. We just don't have information about that, so we can't go with goodwill. The investment in Lambda has been correctly recorded. There's nothing to be added to that investment account unless we were to buy any more shares, but we've already bought all the shares. So there's nothing more to buy. Okay? Is that making sense to you folks? Or okay. See part two. Sales went up by 20%, which was not enough, so no additional payout. We're not going to pay any cash. We're not going to keep the contingent consideration as well. We have to close out the contingent consideration liability because it's outlived its purpose. So I'm settling a liability without paying anything. What do I credit? Absolutely. It would be the mirror image. So if you settled a liability and paid less than you expected to, the difference is a gain. And asset retirement obligation is something that you folks have done. It's a pretty straightforward thing. I'm sure everybody here learned about it in the second intermediate course, which wasn't a whole lot of time ago, and just last semester for most of you. So